Here is a question that could make or break your financial future. What would you actually do if your crypto portfolio dropped 30% overnight? Not a hypothetical scenario. On the 25th of June, 2026, Bitcoin collapsed below the $59,000 mark, wiping billions from the global market in a matter of hours. And yet, plenty of investors held. Some of them did so wisely. Many did not. The striking thing is that the difference had almost nothing to do with which coins they owned. It had everything to do with what they could genuinely survive holding when things turned ugly. As of today, the 22nd of July, 2026, that distinction is being called the most important question in crypto, and if you have never seriously asked it about your own portfolio, this video is for you. Most crypto content online asks the same question on a loop: which coin do you buy next? Bitcoin or Ethereum? Altcoins or stablecoins? Layer 1 or Layer 2? But CoinDesk flagged on the 22nd of July, 2026 that this is fundamentally the wrong question. The real question is not what to own. It is what you can survive holding when the market turns against you, as it has done repeatedly and will continue to do. This reframe changes everything about how you should construct your portfolio. Owning the best asset in the world does you no good if you panic sell it at the bottom of a correction because your position size was larger than your stress tolerance could handle. The selection decision is secondary. The survival decision comes first. The evidence for this shift in thinking has been accumulating throughout 2026. In May, the Chicago Mercantile Exchange announced it is launching a Bitcoin VIX, a formal volatility index modeled on the one used for traditional equity markets for decades. That is a landmark development. It means Wall Street is formally acknowledging that Bitcoin's price swings are a measurable, tradable, and hedgeable risk, not simply noise to be ignored. And then there is the cautionary tale of Michael Saylor, whose company MicroStrategy held over 400,000 Bitcoin and yet saw that enormous position reported as underwater as recently as January 2026. The average purchase price across those acquisitions had risen high enough that a sustained market dip pushed the unrealized value negative. He did not sell. Whether you call that discipline or stubbornness depends on your perspective, but it forces every investor to confront the same underlying question: could you hold through that? Surviving a crypto drawdown is not about having what the internet calls diamond hands or an unbreakable will. It is about three very practical things: position sizing, liquidity, and emotional capacity. If you have borrowed money to buy Bitcoin, a 30% drop can trigger margin calls and force you out of a position at the worst possible moment. If your crypto holdings represent 80% of your total net worth, a prolonged bear market stops being a paper loss and starts reshaping how you live. If you have a mortgage payment due, school fees approaching, or no emergency fund in cash, volatility is no longer an abstract concept in a chart. It becomes a personal financial crisis. The investor who survives is not necessarily the one who picked the superior asset. They are the one who sized their position honestly enough that a 50% correction does not force a change in their daily life. As of today, the 22nd of July, 2026, the crypto market is navigating a period of genuine and sustained uncertainty. Bitcoin's dip below $59,000 last month rattled confidence across the board, and while prices have shown some stabilization since then, overall sentiment remains cautious and fragile. A significant portion of retail investors who entered the market during the bull runs of 2024 and 2025 are currently sitting on losses. Some are selling in panic. Others are averaging down without a clear risk plan. Meanwhile, institutional players operating through CME futures and options contracts are hedging more aggressively than ever before. The gap between investors who have a thought-out framework for holding and those who are simply reacting to headlines has rarely been wider. And that gap is exactly where fortunes are lost or preserved. So how do you determine what you can actually survive holding? You run a stress test, and you answer three questions honestly. First, if this asset falls 70% from my entry price, what happens to my finances, my relationships, and my day-to-day life? Second, can I genuinely leave this capital untouched for 2 to 5 years without needing it, even in an emergency? Third, have I done enough research to maintain conviction through brutal headlines, not just positive ones? Your answers to those three questions define your correct position size far more accurately than any price prediction or analyst target. Blockworks reported in early 2026 that even experienced fund managers at firms like CMS Holdings are entering markets with unusual caution this year. When veterans describe themselves as moving carefully, that is not pessimism. That is risk management in action. Looking ahead, the CME's introduction of a Bitcoin VIX is likely to make institutional approaches to crypto more structured and systematic over the coming months. When volatility is formally measured, priced, and tradable, it tends to reduce some of the most extreme short-term price swings over time, though it will not eliminate them. For long-term holders in the UK and Europe, the key signals to watch are continued regulatory clarity around crypto asset frameworks, the performance of Bitcoin ETFs approved in major markets, and whether broader macroeconomic conditions create headwinds or tailwinds for risk assets generally. For shorter-term participants, the new volatility index will provide better data on expected price ranges, but it will not solve the fundamental psychological challenge of holding through periods of deep uncertainty. Here are 3 steps you can take right now. First, audit your exposure today. Write down your total crypto holdings as a percentage of your total investable assets. If that figure is above 20%, ask yourself with full honesty whether you could hold through a 60% correction without it affecting your financial obligations or your mental health. Second, review your liquidity position. Your crypto should never double as your emergency fund. Keep a completely separate cash buffer that covers 3 to 6 months of essential expenses, entirely outside your investment accounts. Third, set a rules-based rebalancing trigger rather than an emotional one. Decide in advance, right now, at exactly what percentage gain or loss you will take action, and write it down. Most losses in crypto do not come from selecting the wrong coin. They come from making emotional decisions at precisely the wrong moment, usually at the bottom of a correction. The crypto market on the 22nd of July, 2026 is not really asking you what to buy. It is asking you something considerably harder. What can you survive holding when the headlines turn hostile, when your portfolio is deep in the red, and when everyone around you is selling in a panic? The investors who build genuine, lasting wealth in this space are not always the ones who found the next major coin before anyone else. They are the ones who sized their positions with brutal honesty, managed their risk with deliberate rules, maintained enough liquidity to stay solvent through downturns, and remained in the game long enough to benefit from the recoveries that have always followed the crashes. Bitcoin falling below $59,000 was painful for millions. But for those who were sized correctly, it was simply noise. The question was never what to own. It was always what you could survive.